Hello. Um, Welcome to Module 2 of Financial Compliance. Today, we're going to have a brief history of banking regulation. I really believe it's the best way to understand federal banking legislation. We have several agencies, and really through looking at the history and why all these different agencies and laws came to be in place is, I think, the best way to understand it. So, as we talked about in Module 1, a bank is a financial intermediary. Its key feature is taking deposits, although banks also make loans and they process payments. And as we also discussed in Module 1, they have a large role in the monetary policy of the United States. Originally, when this country was formed, we had state banks. Everything was very state-oriented, but it didn't work very well to only have state banks. And so in the 1800s, Congress started trying to make a national bank, and it was challenged by the states. They didn't want a national bank. They wanted there to only be state banks. So we have a long history of this dual banking system and some conflict there. And it was this part of the Constitution called the Necessary and Proper Clause, on which the U.S. Supreme Court determined that it was within the power of Congress to create a system of national banks. So originally, that was not even agreed upon. So I guess conflict between the states and the federal government has been around for a long time. So this is the Necessary and Proper Clause. And based on this, in 1819, in a very famous case, the U.S. Supreme Court said that states have no power by taxation or otherwise to retard, impede, burden, or in any manner control the operation of the constitutional laws enacted by Congress to carry into effect the powers vested in the national government. And this case dealt with states trying to tax national banks out of existence. But the reason we're talking about this in a financial compliance case is because it is the basis of this concept of federal preemption, which is very important for national banks and a very important power that allows national banks, and in some cases, FDIC insured banks, to ignore state laws because federal law is supreme to the extent that it is constitutional. So, right back in the 1800s, we were establishing the supremacy of federal law in regard to national banks. And so that will be important as we look at compliance obligations of national banks. So the current National Bank Act was enacted in 1864, and it created the Office of the Comptroller of the Currency. This is the agency that exists today to charter national banks. They had reserve requirements, which, as we know from Module 1, are now at 0, and they had capital requirements, which continue today, and they created a national currency. So we have the National Bank Act, and that is the basis of laws and regulations governing national banks, and the OCC is the agency that supervises and examines national banks. So if you were to work at a national bank, you would have the Office of the Comptroller coming to your office on a regular basis. The first case that we read is First National Bank of Charlotte versus the National Bank of Baltimore. And what I have here is actually a key section of the National Bank Act, and you can tell that it's old because it's written in words, 24/7 in words. But this is the Powers Clause of the National Bank Act. This was the original clause of the National Bank Act saying what a national bank could do. And in this case, there was a controversy over what a bank could do, and particularly whether it could deal in stock. And if any of you have been involved with a corporation or an LLC, they can engage in any activity that is legal. You just typically charter it, or not, you don't charter it, you charter a bank, you create a corporation, and you say, I've created a corporation to engage in all activities permitted by law. But this case established that banks are creatures of limited powers. Banks may only engage in those activities which are necessary to carry out the business of banking. And so this is another important part of bank management and regulation, is that banks are not free to do what they want. They must fall within the authority of a bank, the business of banking. And so this limits the activities that banks can engage in, and they must somehow sort of justify that the activities they are engaged in are part of the business of banking. So this is a limitation on their powers in a way that we don't see in other types of business organizations. So we have the National Bank Act, and the banks are going along fine. And it's helpful to have national banks, particularly as we are having conflicts with those outside the United States. But we had a run, and we had a real panic in 1907. And what we will see is that banking laws are enacted in response to a crisis. So in 1913, we have the Federal Reserve Act. So in Module 1, we talked quite a bit about the Federal Reserve, and it was created in 1913 when it became apparent that having the OCC to charter banks was not enough. We needed a central bank, and most countries have a central bank, someone that oversees the economy and is, as I said, the lender of last resort. And this was part of the 1913 Federal Reserve Act that is still in place today and created the Federal Reserve. So now you see that if you are a national bank, you will also be overseen by the Federal Reserve. And if you are a state bank, you may choose. And large state banks will choose it, but it does add a second layer of oversight. So this is a bit of how I was talking about the history, kind of explains why we have these two agencies that might at first glance appear to be very similar. But the FRB is looking at the economy as a whole, which includes the banks, and the OCC is much more of a traditional regulator. And in reality, it's probably the OCC that's going to come in and examine the national bank and determine compliance and share their results with the Federal Reserve Board. The Federal Reserve Board will examine the holding companies, but the OCC typically does the actual examination for the national banks. But they have the power to the FRB to examine the national bank. We read a second case, and this was a challenge to the Federal Reserve Board actions. And as I have a summary up here of some of the things they were doing, spreading propaganda, which is somewhat like what I said last week. What they do, they talk about what they're going to do. They were restricting credit through open market transactions. They were raising the discount rate. And they were coercing, which honestly, that's also what they do, member banks to call loans. And so there was a challenge that this was negatively impacting the economy and this individual. And so the questions are, is this legal? Are these actions permitted by the Federal Reserve? And the answer is yes, these are actually all the things the Federal Reserve is permitted to do by statute. They're really carrying out their duties. And one of the things to keep in mind is that regulators, like anyone, are not always right. The Federal Reserve Board is not always right. They try their best, or they don't, I suppose. But I do believe they do. And there is a presumption that they're trying their best, but they're not expected to be perfect. So basically the rule is, as long as what they're doing is permitted by statute, they are within their rights to engage in all of these activities, even though it may not have been beneficial to certain people or several people. It is their duty to try to achieve the goals in the statute with the tools they're given. And if you think about it, if every time they took action and it negatively impacted someone, they could sue the Federal Reserve, it would, nothing would ever move forward. So I did put up just this slide here to give you a sense of the bank failures throughout history. Once we had the Federal Reserve and the OCC, there was a thought that everything was great. We figured out bank regulation and how to manage the economy. And we'll see this repeatedly. But as we know, then we had the Great Depression and we had quite a number of failed banks. The largest number of failed banks, as you'll see from this chart, was during the savings and loan crisis. But this chart is showing you the number of institutions and not the assets. So if you saw a chart that showed you the assets, you would see that the financial crisis in 2008, although it involved fewer institutions, it involved far more assets than the savings and loan crisis. But those institutions tended to be very small, and there were many, many of them that failed. In the more recent bank failures that we saw, I suppose it was last year, in any event, very few institutions failed, but they were high asset institutions. So there's kind of two things to look at with bank failures, the actual number of institutions and the assets involved. But our point is that there was another crisis, and what do we know already happens when there's a crisis? There's a new piece of legislation. And so we had the Banking Act of 1933. So we created the OCC to charter national banks, create a national bank system, but that was not enough. We needed the Federal Reserve to have a central bank. But then we found that yet we needed more, which was the Federal Deposit Insurance Act. So we did not have insurance until 1933, and it was needed to promote confidence in the system. And we will definitely talk more about that later on in the semester. Also part of the National Bank or the Banking Act of 1933 was the Glass-Steagall Act. This was the law that separated banking from investment banking or investment broker houses. Prior to that time, there was some controversy as to whether banks could do that or whether they could do it in their holding company, and the Glass-Steagall Act made it clear it was not allowed. And we also had Regulation Q, which restricted interest rates. There was a concern that banks would pay too high of interest rates on deposits in order to attract deposits. Glass-Steagall and Regulation Q have been greatly diminished, but we still have the FDIC, needless to say. We did read a brief case, and it's really just kind of there for a funny case, I guess, because it's a bank robbery. But the charges were written inappropriately because you are not a member of the FDIC. You're insured by the FDIC. So it is merely an insurance organization. But by being an insurance organization, it is able to impose a lot of regulation. So the FDIC is the source of a lot of the banking regulation, because obviously if you're the agency insuring a bank, you want to regulate how that bank operates. So a lot of the laws and regulations we'll talk about will be coming out of the FDIC. So we do end up now with 3 layers of regulation for a national bank or a larger state chartered bank. And all 3 have examination authority. Although oftentimes the FDIC and the OCC will take turns or share reports with each other. But theoretically, all 3 can come in and examine a national bank or a state member bank for compliance with actually all laws and regulations. Just to talk briefly, because this will come up again, the Glass-Steagall Act had 4 main parts. The first part, Section 16, prohibits a national bank from underwriting securities. The second part, Section 21, prohibits a firm that underwrites securities from taking deposits. So we see here now that these 2 types of companies or 2 types of activities cannot be conducted in the same entity. Section 20 is key because it prohibits the affiliation of these 2 types of companies, those taking deposits and those underwriting securities. This is the section that was repealed in 1999. And then finally, Section 32, which was also repealed in 1999, prohibits interlocking directors, which merely means you can't be an officer or director of an underwriting company and a bank. And again, that was repealed. But just to give you an idea, the key part of this 1933 law, which was designed to separate underwriting of securities with deposit taking. And if you think about it, it may make sense since the FDIC insurance. As I said, Regulation Q at the time set the interest rate on deposits at 3% and the interest rate at loans at 6%. These rates are now set by the market, but at that time, there was concern that the banks would, I guess, go too high really on both to attract borrowers as well as depositors. And this is always the example of the very traditional banking model. You bring in deposits and you pay 3% to attract them. You make loans with that money that you get in deposits, and you make the borrowers pay you 6%, and your profit is there in the middle. So this is really the end of our summary of banking law history, where we see the establishment of the key federal agencies. We'll learn about a new one in the next module. But we also starting to think about the compliance angle, and there will be specific laws under each of these organizations. These regulatory bodies have separate sections of the statutes, separate sections of the regulations. And as a compliance professional, you will need to determine which ones apply to your organization. What are the standards in the law? And then another thing we'll be talking about are the best practices. If any of you are currently in the compliance field, you are probably aware that there are the black letter requirements and there are the best practices. And particularly in this area where the regulators have a great deal of discretion, best practices can also be very important to understand. And the other thing that we will talk about throughout the semester is the importance of monitoring your organization for complying with your compliance programs and keeping them up to date. Because the law in this area is always evolving and changing, particularly because it's such a technology-driven area these days, and technology is changing so quickly. So this really is the groundwork for us moving forward and looking at more specific compliance obligations. As always, I welcome you to reach out to me if you have questions or you just want to discuss something in more detail. So until next time, goodbye.